Entry points are absolute. Exit points are subjective. And that's an interesting concept, right? Stock's been in a good uptrend, trending higher, and now is gently, quietly on low volume, pulled back over 6 weeks from 100 to 80, touching the moving average. You play for the bounce. Exits are subjective. Let's go to the first example. That stock, 20 to 80, backing and filling, 60 to 80, it's breaking out, 81, 82. In we go. Goes to 90, first stop at a winner, and we exit. Take our $10. If it goes to 200, oh my God, what a disaster. Okay, if there's nothing wrong with being wrong, it's staying wrong. So you're in a bad job, get out of it. Get a bad boss, get a bad relationship, girlfriend, get out of it. Sticking with something that's wrong is wrong. And so I have huge institutional clients who say, we don't even discuss it. Put it on the committee meeting unless it's down 10%. They're going 10%. We take a third off down 5, right? So there are no rules.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're talking with technical analyst Carter Worth. Carter's the founder and CEO of Worth Charting. I followed Carter's work for many years, going back to my Fidelity days when he used to visit us up in the chart room in Boston once a quarter or so. It was really good to reconnect with Carter, talk about some of the timeless technical analysis tools, some of the ways that technical analysts and investors using charts in 2026 have such great advantages using some of the computing power, but how some of the classic hand-drawn technical analysis techniques still make a ton of sense and why. So please enjoy this conversation with Carter Worth of Worth Charting. Carter is known as CNBC's chart master. He's the founder and CEO of Worth Charting. A name and a person who I've followed for many, many years, going back to my Fidelity days. And Carter, it's awesome to see you again. Welcome to the show.
Likewise. Thank you. Yes, I do remember obviously seeing you there at the headquarters when you were running the effort in the technical area. You must miss the chart room. That's such a fun thing, among other places.
For sure. I have very fond memories of parts of my experience at Fidelity, for
yes,
sure.
Not all experiences.
But running the chart room, I miss the resources and the appreciation for market sentiment and psychology 100%. And people should know that we would bring in a number of different people to talk about the markets. Your meetings were always very well attended by the portfolio managers, by members of my team. And it was one of those like can't miss meetings. So I'm really excited to give our viewers today just a piece of what I used to enjoy connecting with you. So, I mean, Carter, you always have done such a great job, I feel like, of telling the story of the markets through charts. When I think of you, you often talk about how the charts tell a story and how they kind of bring market activity to life. Tell us this just to start things off. When you're trying to read, a chart, what are you trying to read when you first bring up a chart, when you first try to make sense of things?
Sure. Well, I mean, I think the first thing just is a default, and there's only two groups of people, right? One either accepts the concept that there's wisdom in price, or one doesn't, right? And so there are people who just will not have it, and then there are people who have come around at one point, as we all did, to realize that the market and the study of prices is really more important than the study of companies. Or as someone like a Peter Lynch, on a long-term basis, years and years, there's 100% correlation between the shares of a company and the earnings of the company. But that's not going to help you this month, next month. That's not going to help you when a stock like Microsoft can drop 30%, rally 30%. It's only one thing. It's the study of prices. And that's what charting is, right? Even though in its modern era, it's become unbuttoned. There's some 140 recognized oscillators and indicators. It's really the study of price and volume, right? And volume is the key. The existentialist, the Camus, the Sartre would say existence precedes essence. And in markets, volume precedes price. You want very heavy, aggressive accumulation or distribution, right? And that is a sign that something is happening. And then just one other thing, to put that in context, it really is also just this. It's current price juxtaposed against past price in order to determine what lies ahead. And what I mean by that, that's the same in the world of fundamentals. For instance, here we are. Let's say we were together in a conference room, the two of us, and someone burst in and said, Carter, Dave, XYZ company just earned 25 cents a share for the quarter. Just dangling there all by itself, that means nothing. If we then the last 10 quarters, it's earned at least $1. Be like, oh my God, 25 cents a share. It's relevant to the past. Or in turn, the next minute, someone goes, stock XYZ has just earned 25 cents a share. We're like, what? It's never been profitable. We were anticipating 2 cents. So that current piece of fundamental information in and of itself means nothing. It's as it's juxtaposed against past fundamental. And so too with charts, right? A stock that is just rallied 16%, it's down from 80 to 12. Who cares? Or the stock's been range bound for 2 years and just broke out and is up 16%. Let's care. Meaning it's all about where you are now juxtaposed to where you were in everything, right? And same with the student. You believe this? Ralph just got a D. What? Ralph always gets A's. That means something. Can you believe this? Helen just got a D. Helen's been failing that year. That's tremendous. This is it. Yeah. The basis
context matters, right? It's such a great way of illustrating it. You're absolutely right. So often I feel like, and certainly as investors, you get caught up in the headline as opposed to really thinking about the context. And again, reflecting on some of the meetings that you shared when I was in the audience, you did such a good job of trying to provide that context. Do that for us today if you could, because we're just wrapped up the second quarter of trading. We went from an incredibly strong April and May, where it felt like the major averages could do no wrong. All of a sudden, June, kind of a sloppy, choppy, sideways kind of experience for investors.
Sure.
How do you, when you're looking back at June and just the second quarter, what does it mean in terms of how we finished, and how does that set the table for Q3 in your mind?
Yeah, so the sideways action that you're referring to, a little bit dodgy, a little bit of stall churn for now 3, almost 4 weeks. Again, it's the preceding condition. It's happened after a huge run-up from the lows of March. And so in that sense, I would judge it to be normative, right? The huge, aggressive post, whatever you want to call it, Iran-US dust-up, which in itself dropped the market about 10%. So in terms of sequencing, and that's really what charting and studying sequences, we get the news-related or geopolitical-related 10% pullback, and then you get an even more impressive recovery back to the high from which the sell-off occurred, and then new highs. And so the sideways action, I would judge it as normal enough consolidation post a very aggressive March move.
So I love that. And again, you continue to put things into context, which I think is one of your superpowers as you're looking at the markets, and should be one of our superpowers looking at charts, is recognizing what happened in 1 month. It matters what happened in those months prior, right? And it's sort of the context for sure. So you alluded there in your comment, Carter, about events in the Middle East, of course, which still, while appearing to have quieted down, still appeared there's some volatility there in terms of the headlines. We've got a new Fed chair. We've got all these sort of macro things. In your career, when I think about it, you've been at a number of shops where technical analysis has been not the only story. It's been part of a much more, larger, holistic thought process, thinking about the macro, the policy, the quantitative, and then the chart. So at this particular moment, when there's so many macro forces that I feel like we could be nervous about, panicked about, where does charting fit into that larger picture? And does it help clarify? Is it just a piece of the puzzle? Like, how do you think about, headlines in the Middle East? How does that affect or inform your analysis of the charts, I guess?
Yeah, so I don't incorporate anything related to that, meaning, in fact, it's as pure as this one, as you do, every chartist does, you go through hundreds and hundreds of patterns, right? I have the tickers removed. And so I'm just looking at lines. So there's no bias. And everything, that's Ford. My first car in high school is a Ford. Yeah, I don't like Ford. There's no room for that, right? Or that's a semi. Of course, it's exempt. And so I don't incorporate any of that, although that is the principle of the market, is all reflected, right, in the current share price. And so there's a lot of volatility here. We know that, right? And it's because of things that are macro related, but it doesn't change the process, right? How stocks break out, how they, if they're an uptrend, have a counter trend that brings them all the way back to a moving average, let's say, where rebound potential is high. The general setups are immutable, and it is remarkable. And I know you appreciate it, that the And my mentor, actually, he started in the Fidelity chart room in the 60s, and we met at Donald Selufkin and Jen Rett. But how these patterns that these original people were seeing, they still repeat, which is so phenomenal. And there were no computers, right? And they're doing it by hand. He would do it by hand with a pencil, and you have to get a certain lead, and we would use the mechanical, endless. But that I think they were. No one believed them, right? They were the world is round, no, it's flat crowd, and they were desperate to make it clear, and so they came up with things that are kind of kitsch, like call it a head and shoulder, because someone will recognize that as head, and a cup and handle. Oh, it does look like a cup and handle. That's not what it's about. They're reversal formations, how something starts to change and reverse in an uptrend or down, top or bottom. But it's amazing that those patterns play out today, just as they did 100 years ago. So a long answer to the question. Geopolitics aside or included, the patterns repeat.
That's so well said, Cutter. And I know I was just speaking to someone else about the Edwards and McGee book, kind of one of the classic texts on chart patterns. And even though you can tell that the charts in that book, the visual aids are obviously very antiquated and taken from mid 20th century charts, but the patterns could be charts we're looking at today. I mean, there's no real difference, I would say, right?
No, there's none. And if you even think about moving averages. So without a computer, and notice the original, there were no moving averages. Why? Well, we'd be waiting up all night. And then when we got the close for inland steel, we'd have to then take, I use the 150 day, we'd have to take on our piece of paper, we'd write in the close, we'd remove one from 150 days ago, we'd add them all up, divide by 100, and we draw the moving average. A moving average is an automated trend line. Right, where you're trying to automate the process of a lot of line drawing, very valuable and helpful in the modern era when that wasn't available to them. And you'll see in Edwards and McGee there are no moving averages because they had no computers.
Makes me thankful we live when we do, Carter. At least we have the advantage of technology. And I learned technical analysis all on screens. I was probably one of the first, our generation sort of learning it that way. And the old guys at the time thought that was a really bad idea, and I followed their advice to hand update charts, which
it's so valuable to get a feeling, and that's what he made me do. He was German, and there's certain leads. Certain leads are too brittle. With mechanical pencils, you twist it out and you get it too. Certain don't have a dark enough crispy line, and so certain leads. And I buy the leads and I draw them in. He said, "You have to do this. You have to get a feel for it, just as you would anything. If you're painting or kneading dough, right? You get a feel for the behavior of the money, as opposed to just." There it is on the screen. And so, a lot of line drawing.
You've mentioned this mentor a couple of times. Can you tell more about who this was and how they impacted your thinking?
He was Vincent Boening. He's German. That's the anglicized name is Boening. If you Boening, Vincent Roland Boening, and he was son of a Lutheran minister who came from Germany, and ended up at Fidelity in the late 60s.
That's fantastic. I feel like it becomes, as we get more and more gray hair, and I definitely have you beat on that line, Carter. I feel like it's our responsibility to recognize the technicians past, many of which sadly aren't with us anymore, and just make sure we celebrate some of the work of these giants whose work we continue to hopefully iterate on. So tell me about this, right? As the markets have been more sideways in June and now going into July, there's a lot of thinking, seasonally one of the strongest months. I'm curious how much seasonality plays into your thinking. It's been sort of hit or miss, I think, in 2026 so far. Right? Some months have kind of followed the pattern. Others have been kind of a head scratcher different. But by any stretch, July has become one of the strongest months. Does that play into your thinking at all when you're evaluating charts, or is that just a natural outcome of the analysis?
Yes, it's a derivative of. And so let's take the ultimate instance of that. And 1 million, there's something called the Stock Trader's Almanac, right? There are endless iterations and permutations that, Super Bowl, and, so not to make fun of it all, but, you have to have a process, and you have to draw the line somewhere. It's one of the reasons I don't use oscillators. You would go to a meeting and said, well, I like RSI. So what does that mean you like? It feels comfortable, like a good sure. Do you like MACD? No, I don't like it. What does that mean? You don't like it. Once you use one price oscillator, you got to use them all, definitionally, right? You can't say, well, that's for me. What does that mean? I mean, that wouldn't work up with Mr. Simons, right? Jim's a mathematician, He'd be like, no, there's no like either. What are you talking about? So I myself, and this is a long answer to that question, no seasonality. In fact, just relying on 4 bits of data: the high on the day, the low on the day, and the close, and the volume. Now, the only two other things that are relied on, 150 moving average, is derived from those 4 bits of data. And then, of course, relative strength, very important. But that too is price relative to a benchmark, to a sector, to a peer.
Well said. And again, reflecting on my experience following your work, Carter, it's simplistic in terms of the data points that you're using, but ends up being so sophisticated in terms of our ability to make sense of the markets using that process consistently. You hit on the R word, relative strength, which I think is a fantastic place to go next. Certainly core to my own process as I'm evaluating market conditions. We're at one of those times where relative strength in some ways has been relatively localized, right? I mean, you've got technology, one sector clearly dominating on a relative basis, but then other kind of spots sort of popping up at different times in financials and industrials and other places. How do you think about the dominance of technology going into Q3? How much of a narrative is that versus our ability to kind of detect good charts in other sectors, which they're there, I think, right?
Oh, there's so many. There's always, right, individual plays, right? Whether it's to be overweight or underweight, to be long or short, based on price action and good setups. But the tech sector is bifurcated, right? And bifurcation is a bit fragile, right? You have steep, uncorrected names. Those are all the names we know. And they can quickly come up. Look at Western Digital. It was 800 in 4 or 5 days here. It's now 600, right? That happens in a flash. And so you have one area that is loved, increasingly steep, uncorrected. And then you have an area that is really out of favor, software. And that's not new, but it's as extreme as it's ever been. And more often than not, interesting, the bifurcation, when you have it at the market level, is resolved by lower prices for the aggregate, right? And so if you think about the peak in 2007, but we were going in, the banks had already turned down when the market peaked in October of 2007, and the banks had turned down in consumer discretionary names 3 and 4 and 5 months before, as energy was going higher and higher, right? You had a very bifurcated market. It usually ends, because the thinking is, at least as I learned it, was that the strong ones have an accurate read, right? That they are telling the truth, and that the weak ones that have rolled will come back and recover. But more often than not, it's the weak ones that are actually telling the real story, and that there's this classic, they shoot the generals. Last people are clustering in fewer and fewer names. Now, the semis is exceptional here, right? We know that this, in terms of just spreads above moving averages, record, except for one other time in late 99 and so forth. But my view is to be underweight semis here. And I think that will be, or for instance, and this gets to relative strength, you can also have excessive relative strength, right? When you get, listen, this is interesting. Of course, I just did for fun on a Claude and on a ChatGPT, and I did Bloomberg AI and one other source. I said, my guess is down 60%, but could you confirm that the usage of the phrase Magnificent Seven in print, in Wall Street reports from sell-side analysts, in media, Forbes, Fortune, Barron's, Wall Street Journal, CNBC, has declined by 60% over the last 9 months. And it did it, thinking, it came back 55% decline, meaning things are loved and then they're not. Yeah. Precious metals, gold was loved, now everybody hates it. Oil was being extrapolated just 4 weeks ago to go to 200 a barrel. And so I think relative strength is important both ways. Energy was the best relative performer of all, but now it's so bad it's good. Like, I think you step up and you be contrarian and you buy energy. And of course, the sector itself is dominated by Exxon and Chevron and Conoco, but I think you go overweight so forth and so on. But relative strength is very important. If you think about it, of all the factors at the big quant models, the relative strength and momentum have been proved to have efficacy, to be robust generators of alpha. And it's not just it's not just the market. Momentum isn't, it's not the stock market. There's downside momentum or stock and run all the way down and down and down, and there's upside. But it's not a market concept, right? It's a concept from the natural world. And so in sports, a political campaign is doing well. And guess what? And it's continuing to do well. Or a sports season, they're doing well, and then they're winning again. Momentum is very powerful. And in life, the young person comes out of university, Phi Beta Kappa, top. That's momentum. And guess what happens? Gets the job, the big job. and then gets the apartment, and then gets the girl. And I guess what happens? He loses the job, loses the apartment, loses the girl. The premise, the momentum in life, we've all had it. Like, what is going on? It works. And then you're like, oh, this is really good now. And same with stocks. Yeah, same with the market.
And it's so, and during bull market phases, as you and I both know, Carter, there's always extrapolation to some extreme level. And I think that is just one of the key features of the left side of any sort of bubble-like move. And I think we saw that with energy. We saw that with crude oil. We're certainly seeing that with semiconductors now. I'm curious, Carter. I mean, with and I guess the short question is, how do you know when you're wrong? And I guess the way I would ask a somewhat more nuanced question would be, let me take either of these examples. Like, all right, energy's so beaten down, it's probably good. Like, what do you see on a chart that tells you, okay, that thesis is no longer working, right? What does a stop look like, or an exit strategy look like to you? Are there general tools and techniques that you use to kind of manage that downside risk that I feel like every investor is afraid of at all points in the cycle?
Sure. Well, just to defer to the mentor again, he said entry points are absolute. Exit points are subjective. So let's take it, and then I'll get to energy, but let's take a stock that, having ascended from 20 to 80 over a 2-3 year period, has now been backing and filling between 60 and 80, 60 and 80, 60 and 80 for 2 years, and now is showing some bullish price volume correlation, and then is starting to break out. That is something that one embraces, right? As a moment in time. And remind me what you asked, because I was going to say something else and I've forgotten.
About an exit strategy, right? And how what you see on the chart.
That entry point is absolute. It's what he would refer to as a conventional buy structure. Convention is something that's generally agreed upon. It is generally agreed upon, even outside the technical world, that a stock has gone from 20 to 80 and is backing filling in 1680 and starts to press above 81. You buy that. That's called the breakout. That's general. Okay. And so entry points are absolute. And that's an interesting concept, right? Stock's been in a good uptrend, trending higher, and now is gently, quietly on low volume, pulled back over 6 weeks from 100 to 80, touching a moving average. You play for the bounce. Exits are subjective. Let's go to the first example. That stock, 20 to 80, backing and filling, 60 to 80, it's breaking out, 81, 82. In we go. Goes to 90, first stop in a winner, and we exit. Take our $10. If it goes to 200, oh my God, what a disaster. Okay. And market has a way of doing this, of course. The ones that you buy at 80 and you say, all right, it's now 9,500, let's sell it. Those go to 200. And then the ones, it breaks out, it goes from 80 to 100. You say, we're going to stick with this one. Those ones, they go back. But the point is that entry points are absolute. So how to manage winners is really harder, though, which is now getting to your question, losers, because there's nothing wrong with being wrong. It's staying wrong. So you're in a bad job, get out of it. You got a bad boss, you got a bad relationship, girlfriend, get out of it. Sticking with something that's wrong is wrong. And so back to his point, this is tied all together. It's subjective. I have huge institutional clients who say, we don't even discuss it. Put it on the committee meeting unless it's down 10%. Other go 10%. We take a third off, down 5, right? So there are no rules. Now I have my own thing. I act in thirds, just when it's in a PA. I mean, if it's down, and I use 7, I take a third off just to be disciplined, and then down 10. But it's also the behavior of the money. So let's talk about that. People say, what do you mean by that? It's how it's acting. So $100 stock in a good uptrend, can going from 40 to 50 with nice little jet. Then all of a sudden is pulling back to 98. Fine, 96, 91, that's normative. I mean, uptrends are punctuated by countertrends, which are givebacks, right? Sell-offs, drops, declines. And I could take it all the way to 90, 10%, that's nothing. Still above a moving average, down to 100, now it's 90, now it's 88. That's all within reason. Scenario 2, $100 stock, it drops in gaps at the open, 96, down $4 of it, walking away. So think about it. I've just said one scenario, $100 stock, I'm willing to go all the way to 88. Seems normal enough, quiet, controlled. The other stock, I'm selling 96. So you're saying you're contradicting yourself. One $100 stock, you'll take it to 90, maybe 89. The other one you're selling at 96, it's the behavior of the money. It has to be news. It has to be something that caused that drop. And I don't look at news, but I know that's a first loss, best loss. And sure enough, you'll go find stocks don't just drop and gap. And it's already treated average daily volume by 1030. You're like, something's wrong. right? So it's the answer is there is no answer, but it's the studying the behavior of money. It's subjective, and there are some rules of the road. Drops and gaps are bad. First loss, best loss is an important thing. And then obviously you just can never let something, I come in all the time, people say, we're down 30 on this one. We're thinking about, that's unacceptable. I mean, what are you talking about? But anyway, to each his own.
No, I appreciate it. And I love that. I love that quote, right? That the entry points are absolute. The exit points are subjective.
Exit points are subjective.
Yeah. Well said. I like that a lot. That's a keeper. So tell me this. I mean, with you've had a number of really cool roles in the industry, and I've enjoyed following your career. It's been, and I will tell you, I am thankful for one thing that CNBC has, anointed you a chart master, and just the fact that they celebrated technical analysis and have featured your work for so long, I think is awesome. Talk to me about your firm, Worth Charting, which again,
Sure.
Fantastic name and well done. What are you trying to accomplish there? I know for institutions, you do some work, but also for retail investors as well.
Indeed. So there's three lines of business, if you will. The first is the traditional business that we've been in for 35 years as a sell-side analyst, producing actual ideas or thematic reports for the biggest mutual fund complexes in the world. For instance, when we were interacting when you were at Fidelity, the biggest hedge funds in the world, pension plans, endowments, RIAs, family offices, and so forth. So that business is a business where, as any analyst, I have to get paid for my work and I'm judged on its veracity. And that is just traditional sell-side analysis that is being done at Goldman Sachs, Morgan Stanley, and everybody else. And some of those firms have technicians, some don't. And I'm there competing, just as I always was, with the other known technicians on the street.
And then you also do a couple other things with Worth Charting, right?
Yeah. So then we have a subscription business for individuals, and there are a lot of. It started where there would be a PM that would be leaving somewhere. He said, "Well, I'm going to leave, or I'm retiring. Can I still get the work?" He said, "Sure." And you would never turn someone down. We said, "You should launch an online subscription where someone could and do that." And so for a monthly rate, people, and it's very modest, it's $200 or whatever it is, and that people get all of the research. There's no interacting, obviously, again, because that time is spent with institutions where we're doing portfolio reviews, we're going in-person meetings with PMs and so forth. But that business, the online subscription, is for individuals who want to see the recommendations and all the thematic work. And then we have a third, which is new. We launched Worth Charting Options Income Fund, and got a nice symbol for that, WRTH, just taking the vowel out of worth. So that was conveniently available.
It's an awesome ticker, and congrats on the ETF launch. I saw the announcement about that. I was really excited for you. What particularly, you mentioned it's an options income ETF. What's the structure of that ETF? What are you trying to accomplish with it?
Yeah, so what it's for is the people's most conservative money, right? Well, you have your speculative money, you chase semis, or you buy gold or short oil and so forth, or just in general having exposure to equity markets. This is intended to be one of the lowest vol, lowest drawdown vehicles one can have, seeking 11% a year, just like that, sort of 10 to 12, 11, 12% a year, with very low drawdowns, not much more than 6 or 7%, and paying out a quarterly dividend and paying out essentially all the gains. And it is an income, right? But it's based on options. And here's, not because we're interested in options, it's because the only way to do what the premise is. And this is the premise. Any investment or proposition or endeavor that anyone has presented anyone with ever, it's based on, if you commit capital to this, we believe that capital will appreciate because we are making a directional judgment, meaning we want you to come in on this restaurant. It's going to be a big one, and you will be an owner, and it will make money. We want you to invest in this play. They're called Angels on Broadway. And we think want you to invest in this stock or this hedge fund or this mutual fund. The premise is 100% the same every time. This real estate investor, you commit capital, and we, the managers of this idea, the proprietors, believe that it will go up in value over an indeterminate term could be 2 years or 10. The proposition of this vehicle is we believe that the stocks that we select based on the following criteria, which I will articulate, will go sideways in a range for the next 15 to 20 sessions. That's it. We're not calling a direction, making any judgments about their value. And so here, I'll give you exactly what we're doing. People buy and sell options. We know this, right? And they options out of the money. Let's take a $100 stock as an example. So if you were to query and look at all the data, it's all available. What percentage of all out of the money options expire worthless? So $100 stock and short term, front month. So with 20 sessions or less, right? So $100 stock, you could be out of the money, could be the 101 calls or the 99 puts. It could be very profitable. The stock moves up or down. So the baseline is that 75% of all out of the money short-term options, front month, expire worthless. So those are good odds to start with. Not to buy them, to sell them. Okay. And then we have the following overlays. We don't sell out of the money options that are $1. We sell that are 2% out of the money. So in the $100 stock or more, we've been selling the 110 calls and the 90 puts. Okay, so if you add that criteria, your hit rate, just the odds of all options, you go to the CBOE and look at, check on, it goes from 75 to about 85 because you've given yourself now that stock will have to move in 15 days, 10% or more. Okay. Now, the following three other overlays. Well, the nightmare, of course, of being naked, right, is the stock gets bought out. It's a small cap stock. It's like Deckers or something, and it gets acquired by Nike, whatever. So the next criteria is we only do large cap, no small cap, S&P 500 stocks, which too can get bought out, but it's highly unlikely compared to the rate. And so once you do that, it takes the odds to 90%. So we now have out of the money options, 75, out of the money by 2%, 85. Small cap eliminated, large only, takes you to 90. Then two more criteria, no biotech. Biotech gets FDA approval. Your $100 stock goes to 300. You got a big problem on your the 110 calls, right? Okay. And that takes you to about 92, 93. And then the final criteria, we sell these strangles, selling calls and puts, only after a stock has just gapped up in response to earnings by 10% or more. So to think of it, the number one thing that moves stocks in a shocking way, right, is earnings. Happens all the time. They missed, boom. They got it up, boom. Okay. So now that takes you into the 95, 97, just looking at all stats. So we now have a $100 stock. The biggest risk is we're naked, calls, and it has a big earnings beat or miss. But we've acted after earnings. So now this is the scenario. $100 stock, it just reports, it gaps up 10%. So now it's 110. And we're going to sell the 120 calls that are 10% out and sell the 95 or 100 puts. Okay. So we now are going to wait just 15 sessions. The stock, we have no earnings risk. It's not going to report earnings. They just did. Yep. We have no biotech. It's not going to report FDA approval or miss. It's not going to do that. And so now it's just waiting for decay. So you have a vol spike and we're waiting for vol crush. But the key is that it's just gapped up. So we'll go back to that example, 100. It's gapped up to 110. And now we're naked, right? Sell the 120 calls because there are people who think it's going to keep going. It's going to keep going. So there's momentum drift risk. It could go a little more, but we've modeled for that by being at 110. So this stock, which is just up 10%, would have to go up another and go to 120 in the next 15 sessions. Well, if it does that, the put is going to be losing value. And so what we're finding is they're staying in this range as a very high probability of the time. Now, let's think about the nightmare scenarios. All the money is kept in T-bills. We never want to own any stocks. Okay. There's so many of the ETFs that sell covered calls. This is the only fund that's doing this. So all the money is in T-bills, earning a rate of return. And so they say, well, what if a stock gets put to you? Well, it's a cash secured put. So that stock, it's 100. We sell the 90 puts, right? Or whatever we've sold, and it drops to 80. Isn't that risky? It's no more risky than the person who bought the stock. The person who bought the stock at 100 and we sold the 90 puts, well, it's now 80. The guy who bought it at 100, he's down 20. We're down we saw the 90s, we got premium, you're better off, right? That's there. So that part is less risky than just buying a stock outright. Now let's talk about the runaway. $100 stock, it does go to 200. The only way that happens is going to get M&A, right?
Yeah.
Okay. We buy far, far out of the money calls as to risk insurance. So we have the strangle on the 120, 90, whatever it is, stocks trading at 110. We're hoping for just decay, 15 more sessions and just sideways. And that's what is the nature of charts. It's based on charts because what happens after a stock, they talk about a big flag and then and the flag after the pull, the heavy volume up thrust, and then it flags and it flags. Do they always, sometimes they keep going. But we've modeled for that. No, this is not infallible. We've had ones that have gone outside the strangle, up or down. But the point is that the real nightmare scenario is that it goes a lot more, right? Mm-hmm. But we've got out of the money calls, let's say the 160s, to guard against my gosh, it's a $300 stock. But big, large, here are the numbers on S&P 500 stocks. If you look at all buyouts of publicly traded stocks, the S&P 500 over the last decade, and you can go back further, what is the premium paid? Because it's 30%, 35%. There are no stocks just sitting around that are worth 200 billion that get acquired at 3x. That happens for small stocks.
Yeah.
So that we're never going to have a scenario in principle where a stock 100 goes to 100. But let's say that happened. All positions are equal weight. So in the 50 million, right, every position's, 2 million or thereabouts. So if one's position were to go a double against us, right? We've sold the one and it goes to 200, even though the insurance kicked in. Let's say we didn't have the insurance. What does that mean? That means that position doubled, right? Well, if a position is 2% doubles, it's 75 basis point impact on the fund. It just, we believe we've modeled for that. So nightmare scenario up, FDA approval, we don't have that problem. Earnings, we don't have that problem. We're after earnings. Momentum drift, yes, you'll see a stock might gap up a second day, but we've put enough of a band. So they don't always expire, but we have a high hit rate where they just expire worthless. And so we watch the spots on the banana start to accumulate, turn black.
That may be the first banana metaphor in the history of the Market Misbehavior podcast, Carter. That's a good one. But I like that. No, really, honestly, congrats on the ETF. That's a really interesting structure. And what I love about it is, as you're describing it, it plays on a lot of the things that we talked about how stocks usually trade, about the context, about recognizing and modeling some of those common patterns that we've seen and trying to generate some income with that. I really appreciate you talking through some of the nuances of that. And congrats again. We'll make sure we include a link for more info on the ETF and also your website, Worth Charting. Just to finish off, Carter, and this has been awesome. Great to reconnect with you and great to get your take on the markets, but also just investing psychology and methodologies. Tell me this. You've had an incredible career as a technical analyst, and I respect you greatly for what you've accomplished. What's one lesson you feel that charts have taught you over and over through the course of your career?
Yeah, you know what it is that when we have our biases, right? And that any time one starts to think, this really belongs here, or this shouldn't be happening, it's just never right. The market at the closing price at 4 p.m. on the floor of the New York Stock, so-called, I know it's not that, is what it's worth. And and the notion, you learn the lessons over, no, this one should be, there's no should. It would be there. And so that is it. It teaches you humility, but it teaches you just, to listen to the music of the market. Listen to the market. The market is wise.
Carter, great to see you again. Thanks for coming on the show. I hope we can continue the conversation at some future date, but for now, I say thanks for sharing some insights with us.
Thank you again. Okay.
It was such a fun conversation. It was great to see Carter again. I haven't seen him in a number of years, and it was really cool to reconnect with him. In some ways, it feels like no time passes at all. His meetings, and I was serious when I mentioned that in our interview, his meetings up in Boston would be widely attended. He was one of the most popular, external voices we would bring in to share insights with the portfolio managers and the research team. It was always a lot of fun to hear from Carter. He would famously sort of show different charts, show stocks, and would you rather have this one or this one? Would you rather have this one or this one. And the way he would do that would just be so brilliant, because he would just do these little A/B comparisons. And along the way, we would really clearly see, okay, yeah, I get what he's saying. He's showing this clear rotation from consumer to financials, or from industrials to defensives. But just the way he would do it, his style of presenting was always so captivating. And he hasn't lost a step. I feel he just continues to just have a really good way of breaking down market conditions. Some really fun quotes along the way there. There's nothing bad. There's nothing bad with being wrong. It's staying wrong. That phrase, that sentence, a version of that is something we would throw around a lot in my money management days, where we would talk about, it's okay to be wrong. It's not okay to stay wrong. And that is really the essence of, I think, using charts for risk management, right? And part of it, analyzing charts, it's not just about finding the next buy idea, which is what we often think about charts as being most helpful for, right? Let me find the next breakout. Let me find the next big thing and look for good buy signals. I have learned that technical analysis is even more absolutely valuable, indeed crucial, on the risk management side, right? On recognizing when the charts are no longer good charts anymore. And it, it's so common that when a chart starts to look bad, or when we're wrong, we don't want to admit that we're wrong. And by selling that position, we're acknowledging that we are incorrect. So to nurture our fragile ego, we hold on to things too long. And I think that's a great way to think about it. Entry points are absolute. Exit points are subjective. It's a really good way of thinking about that. I hadn't really heard it portrayed that particular way. And he's talking about how the entry point, the signals are always so clear, right? In a lot of ways, right? It's a breakout. There's clear resistance. There's a breakout. Obvious bullish breakout. That's the kind of chart we want. But where do you take profits? Where do you sort of manage your risk? And that's where there's a lot more wiggle room. And I would argue, making your exit points less subjective and more consistent, probably pretty good. And we talked, after that, after he shared that quote, I mean, Carter shared some of his own, the ways that he uses stops in his personal account. I think that's a way to think about it is, he had mentioned doing it in thirds. Having some structure is important. So let's just not make it, made up as we go. Also, just really appreciated his take on the current market environment, about the concentration, the dominance of technology. His comment talking about mean reversion potentially in those high-flying semiconductors versus beaten down energy stocks, I think was pretty interesting to hear here as we kick off the third quarter of 2026. Obviously, congrats, of course, to Carter and his team for launching the worth charting ETF, ticker WRTH. And, it was really actually kind of cool. I was hoping you would be able to talk us through some of the, the structure in that options income ETF. And he really talked in a lot of detail about sort of different scenarios and how it would be structured. Kind of an interesting way to think about the income component of a portfolio relative to all the other things that we do. We didn't talk a lot about Carter's background, a good deal about one of his mentors, certainly early on, but Carter comes from a whole sort of, group of macro strategists. There's a great Ed Hyman who started ISI, and it ended up being just a really successful independent macro research firm with huge following in Wall Street. And Ed had come from a sell-side background and brought a great audience with him, but he did an exceptional job of building up that shop. And so many great technical analysts and strategists like Jeff DeGraff, like Jason Trennert, many others came through that ISI family working with Ed, Nancy Lazar, who Carter worked with, and many others. So great insights there. Carter's had a wide following on the street for many years, and it's the institutional investing community, and now with retail investors and individuals. We'll include links to share more information about the WRTH new worth charting options income ETF, along with his website to get more information about Carter's work. And thanks again, Carter, for coming on the show. Great to reconnect with you. We'll hope to continue the conversation later this year. By the way, if you want to learn more about how to upgrade your technical analysis toolkit, how do you think about opportunities versus risks, potential upside versus potential downside, and making your process less subjective and more systematic, we're here to help. We have a Market Misbehavior Premium membership to teach you what we feel is all you need to know to make better decisions today. 3 great benefits to the premium membership. First off, we'll teach you all about behavioral finance and technical analysis through our virtual courses. Then we will share with you frequent market updates and insights through our weekly flight plan, our monthly chart review, and frequent updates during the week. Finally, you'll have full and immediate access to our member community where you can ask questions and where you can learn from other like-minded investors. I'm in there every morning checking for messages and sharing some charts and insights as well. You can get all access to all of that today by going to marketmisbehavior.com/premium. We'd love to see you join as a premium member today. Again, thanks so much for joining me here on the show today. My name's Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Take care, folks.